Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Great you can have us join us here at AusBiz in what is a busy day ahead locally, where we take a look at the RBA decision. But let's first take a look at what happened overseas. Now, US markets were closed for the President's Day holiday, while S&P 500 and Nasdaq futures are up around 0.1%. In Europe, shares closed at a record high, with the Pan-European Stock 600 index rising 0.5%. Equities were led higher by defence stocks, as investors priced in the likelihood of increased military spending in the region amid US calls to boost spending for security. A gauge of defence and aerospace stocks surging almost 4% to an all-time high, having already more than doubled in value since Russia invaded Ukraine 3 years ago. Shares of defence companies such as Italy's Leonardo gained 8%, Sweden's Saab up 16%, Britain's BAE Systems up 9%, while German conglomerate ThyssenKrupp, which is looking to spin off its warship division, soared almost 20% to its highest level in more than a year. Arms maker Rheinmetall shares surged 14%, also lifting the Germany's benchmark index to an all-time high. Meanwhile, in China, President Xi Jinping has held a rare meeting with the country's tech sector entrepreneurs, such as Alibaba founder Jack Ma and the founder of DeepSeek, and urged them to show their talent and be confident in the power of China's model and market. Well, European Commission President Ursula von der Leyen has said the Commission will propose exempting defence from EU limits on government spending, as President Trump exerts pressure on European members of NATO to finance the continent's own defence against a potential Russian attack. European leaders met in Paris for an emergency summit on Ukraine, after US officials suggested Europe would have no role in any upcoming talks aimed at ending the conflict with Russia. Now, the US Fed Reserve member Michelle Bowman has said monetary policy is now in a good place, saying, given the current policy stance, I think that easier financial conditions from high equity prices over the past year may have slowed progress on disinflation. Fellow Fed member Patrick Harker saying economic growth remains resilient, while the labour market is in balance, saying these are reasons enough for holding the policy rate steady. Well, the Australian 3-year government bond yield rose to 3.87%, the 10-year up to 4.49%. This comes ahead of the Reserve Bank as it delivers its first policy decision of the year, with markets pricing in an 85% chance that it will cut its cash rate by 25 basis points to 4.1%. Ahead of that decision, the Aussie is up at 63.6 US cents. The US dollar index is little changed, and Bitcoin is trading around 96,000 US dollars. Oil prices have risen as an attack on infrastructure slowed flows from Kazakhstan, while investors monitor developments of a possible ceasefire in Ukraine that could ease sanctions and increase global supplies. Brent crude futures up at $75 a barrel. Copper has weakened further, falling another 1.4%, while iron ore slightly lower at $106 US dollars a tonne. And the gold price has again breached the $2,900 level, to be up around 0.5%. So let's get across what we're seeing on global markets at the moment. Isaac Poole joining us from Ascalon Capital. He is the CIO there. Isaac, welcome back to AusBiz. Good to have you with us. Of course, the focus very much again on geopolitics, given what we're seeing in Europe at the moment, pressure exerted by President Trump. Tariffs, it seems, have seen moved to the side, at least for the time being.
They have, yeah. I think all the focus is on what's going on in Russia and the prospect for talks there. But of course, you can't get away from the tariffs still, I think, because we have seen tariffs rolled out on China and on some commodities, and we may see more announced in coming weeks on Europe, and that's going to make the outlook, I think, for Europe in particular, increasingly uncertain. And that's against the backdrop where European equities have really stormed ahead this year, despite, I think, no real signs that growth is accelerating. So we continue to think there's a little bit of risk connected to politics and to economic growth, particularly in Europe.
Yeah, you only have to look at what happened overnight, particularly with those defence stocks, on the prospect, of course, of increased military spending.
Exactly, and this is a sector that has really pushed ahead over the last couple of years, and we're seeing further gains there. And And that may be justified, although there is still an element of uncertainty around all of this. I think what this shows is the market is really struggling to price in geopolitics at the moment, and we're seeing this volatility, two-sided volatility, that could continue, I think, in the near term.
So, Isaac, do you think it's fair to assume that there will be further tariffs? If so, has that been priced into market at this point?
I think we will see further tariffs. This seems to be something that the Trump administration and President Trump himself generally sees as a foreign policy that he can use to leverage other countries to get them to do as he would like them to do. But also he believes that this will be positive for America. So I would expect in coming weeks we'll see more tariffs announced. Now they may be held off if they're used as a bargaining chip. But the real challenge, I think, is that markets find it very difficult to price in both the likelihood of tariffs and the impact of tariffs. And I think we're going to see the sort of volatility we've seen so far this year really persist, and that could be a difficult time for global markets when they're at very stretched valuations.
Yeah, the prospect of those tariffs, the focus has very clearly been on those affected outside of the US. What are we seeing inside, particularly, I guess, with the state of the US consumer prospect, perhaps, that we may not see any further rate cuts?
But this is a really big story, I think, because the consumer has been a real source of resilience for the US economy over the last 12 months. But with all this, will they, won't they implement tariffs? We are starting to see the consumer confidence just come off a little bit. And then, of course, we had retail sales announced last week, which were a lot weaker than it had been expected. So this difficulty could roll down to US consumers. We could see slower consumer spending. It's such a large part of US GDP that if that does roll off, if we do start to see a retrenchment in spending that could flow through to the labor market, we could see a rise in unemployment. All of that would be a very negative outcome for a consumer-led economy. And that really is not priced into markets at the moment.
Yeah, so potentially, and what would we see with earnings going forward?
But that's really the big question here. We've already seen sales growth, revenues, if you like, are just not holding up in the US. They're quite weak, low single figures. Earnings growth has been okay. I think that's as much an inflation story as anything. We've seen margins benefit from stickier inflation, but we are going to need to see earnings really deliver this year. And I think so far we're seeing sort of around 10% or so in this quarter's earnings growth. I think if the consumer comes off the boil, you could see that more like a middle 5% or so, and that will not be good for valuations at this level.
So, Isaac, let's then get to portfolio positioning, beginning with equities. What sort of is an appropriate positioning, given what you just said, particularly as far as those US equities are concerned?
We wouldn't be looking to add here. I think valuations are stretched. If you're overweight and you've been dragged overweight over the last couple of years, as we've seen those really large price gains, it's really time to start thinking about rebalancing back towards your neutral position, maybe taking a little bit further off, going a little underweight, because the downside risks are elevated here. They always are when valuations are stretched. We're seeing them stretch at the moment. It's time to take risk off the table and look to be a little bit more resilient at this point.
What of emerging markets? And I guess once again, it's the tariff story, isn't it?
It's a difficult place to be. I mean, we've seen China and Hong Kong, where a lot of these tech stocks are listed, really surge over the last week. But that's a single story playing out there. And while we think parts of the emerging world are offering some pretty good relative value, you do need a catalyst to find that value. And at the moment, tariffs are looming large. And it means that if you're going to go into that part of the market, you need to have a very high risk tolerance. So you need to be prepared for some volatility. And I think you need to be prepared to see this out over the medium term. This isn't a near-term trade in my view.
And Isaac, what sort of exposure do you think you need in fixed income at the moment?
But I mean, again, this week we've seen spreads just tighten in so much in the high yield space, the sub investment grade space. it's time to really start moving up the quality curve and be looking for solid investment grade, to be looking for treasuries, for government bonds, getting some downside protection. Absolute yields are looking okay at the moment, so you're getting good income, but these are going to be critical, especially if you're looking to rebalance out of equities. The place to go is high quality government bonds, high quality investment grade credit.
And is that US Treasuries?
I think US Treasuries here still look pretty good, and that's you can go across the curve. You can pick up shorter duration at pretty good yields, and long duration up above 4.5%, 10-year US Treasuries. That's not a bad place to be in our view.
Isaac, great to get across what you're seeing in markets. Plenty to consider, of course. Thanks for joining us from Ascalon Capital.
Thanks, Andrew.
So let's turn our attention now to what we're likely to do locally when we open. Now, SPI futures are up around 0.25%, bearing in mind it is a big day. Corporate results, we've already got BHP out, which came in, was a miss across the board essentially, and also, of course, the RBA decision at 2:30 Eastern. We're going to get right across that as well. Stay with us though. The open is a couple of minutes away.